All right. Welcome, everyone. As people are connecting here, I will offer welcome. It's Mark Yusko from North Carolina. Before I turn it over to Corey to give us the global equity market mid-year themes update. Last week we did kind of the mid-year update on around the world and talked about global capital markets broadly. Corey will dive more deeply into the equity markets, and I'll throw some commentary in here in a way. So, you know, summertime, obviously, a lot of people away on break. I'm kind of in between here myself, down in Topsail Island, down south of Chapel Hill, and it's interesting. A couple of things that I think are interesting takeaways. Just lots of people on the move this summer, lots of activity in terms of travel and roads are full and restaurants are full. So economic activity, despite all of the boo birds and the dire warnings based on data. I mean, the data, the PMI data is actually quite bad. Leading economic indicators are second worst they've been this century. Uh, Really kind of interesting dynamics going on. So all that said, I think leads into some really interesting things about global equity markets, which Corey will have some data for you, are as stretched really as they have ever been. Mostly the US, but other global markets as well. And that makes for some very interesting times. And I think really emphasizes the need for talented analysts and stock pickers to have that strong hand on the wheel because the storm, to go with what's happening down here. It can be nice and sunny and beautiful 1 minute, and 10 minutes later it's storming, as June, July, August are prone to happen. So with that, I will hand the ball to Corey, or the rudder, I guess, keep on the sailing analogy, and we'll talk about global equity markets and some themes that we have in the portfolio.
All right. Well, perfectly unscripted and a great segue into my opener. Was going to wish everybody a happy summer and remind everyone that last time we checked in was back in mid-February. And, while Mark's on the beach down in North Carolina, I'm here in Chicago. And in mid-February, it was cold and snowy. Recently, it's been pretty hot and muggy. So, much like markets, Chicago weather, I guess weather really anywhere is pretty volatile and difficult to predict. So, with that caveat and backdrop, we're going to attempt to look into our crystal balls today and provide an update on our market outlook, as well as an update on some of the themes we're paying, very close attention to right now here at the Creek on the public side. And those themes, as a reminder, talked about them earlier this year. We'll provide an update today. Our innovative healthcare, Chinese recovery plays, rifle shot shorts, and last but certainly not least, artificial intelligence. So we're going to keep things, as always, in this forum pretty high level. Um, so if you'd like to dig deeper, on any topic or just talk in general, please don't hesitate to reach out to me, Mark, or anybody else at Morgan Creek. So without further ado, let's get into the slides here. So starting with the market outlook, you may remember this slide from last time. It's a little convoluted, but some good data here. And, always like to use history as a good, framer for the future. And, if you look at 2023, 2024, 20 plus percent years for the S&P, looking at history after two straight 20% plus years, returns the next 2 years have been mixed. So, looking at the data, only after 1995 and 1996, so the light gray bars here, um, were two 20% plus years, followed by two more 20% plus years. You can see that here. 1924 and 1925, so the brown bars, were followed by two strong years. 1927 was up over 30%, but 1926 was up only in the teens, so technically doesn't count. So, and the other seven occurrences here, stocks, after two 20% straight plus years produced below average returns. So looking at the pink bars here, these are the average of those occurrences. And well below average if you take out the 1990s and 1920s outliers we just talked about. So we asked back in mid-February, will 2025 and 2026 be more like 1997 or 1998, or perhaps 1926 and 1927? Or something more average, or even perhaps something more sinister like, 1937 when markets fell 30%, or 1929, this black bar here, and 1930 when markets were off a similarly bad amount over about a 2-year period. We said, however, that however the next 2 years turn out, investors should probably start to at least think about layering in some hedges into their portfolios, because we all know what followed the 1990s and 1920s outliers, i.e. the tech bubble collapse and the Great Depression. So, here we are now halfway through the year. Where do things stand? Let's take a look. So, if you look at this chart here, you can see in 2023 up 24%, 2024 up 23%. And, the first 3.5 months of this year looked a lot more like 1937 when markets fell 30%, while the last 3.5 months, of the year so far have looked a lot more like the 1990s or 1920s outliers after, Trump, really caved on the first tariff threat and earned the not so nice nickname Taco, Trump always chickens out. So a V-shaped recovery, off the lows earlier this year in early April, really understate the rally, we've experienced here over the last couple of months. And, at one point we were down close to 20%. Now the S&P, as of yesterday, when I put this data together, is up about 6%. So, the jury's still out on what this year is going to look like in terms of the prior analysis. And we kind of warned, in mid-February, there's two kind of big macro risks that, we're looking at closely that could derail further, gains in equity markets. One being, higher inflation. And we asked, will there be a second wave of inflation like prior cycles? A lot of things that the new administration is doing objectively, could lead to higher inflation like tariffs, cracking down on immigration, tax cuts, etc. And if you look at prior cycles, there have really been, two waves of inflation typically. Looking at the cycle back in the early 1900s, the late 1930s, early 1970s, and here, most recently, darker blue line, we had the big spike in inflation that's moderated, and the question now is, will we have another wave of inflation like we have historically? So, looking at the data, it's only been a couple quarters, a couple months, a few months, since, the mid-February webinar, but there's been no second wave so far. And the question now is, will it stay that way? The most recent data, this week, there's a small uptick in CPI, but the PPI to, some of Mark's earlier comments actually came in a little bit light versus expectations. So to be determined on this risk factor. And then, this is a very dangerous game to play when it comes to markets, but never have I ever, in terms of some economic data, I think is interesting to look at in the context of the second big macro risk we're paying very close attention to in terms of something that could, derail further equity gains from here. And that's economic weakness that leads to lower earnings. So if you look at the chart in the upper left, we have never seen a U.S. recession with corporate profit growth staying positive year over year. S&P earnings are expected to grow about 5.7% in the second quarter, with revenues up close to 4%. So solidly in positive territory. So we'll see how things unfold throughout earnings season, which just kicked off in earnest this week and over the remainder of the year. But so far, this looks pretty good. Then looking at the chart in the upper right here, we have never seen a U.S. recession without the unemployment rate rising. And there's been a little volatility in the unemployment rate, but it's still hanging in there. And most recently has actually ticked down a bit. So, check mark here. Then looking at the chart on the bottom left, recessionary weakness in the labor market has never occurred in a vacuum. It always has been confirmed by weakness in fixed business investment. And you can see here that we still remain solidly in positive territory. And interestingly, the last chart here on the bottom right, a lot of this capex is being fueled by massive, and that's not an exaggeration, just massive spending in data centers. I mean, we all hear about this on a daily basis, and we'll circle back to this in a bit more detail when we talk about AI later in the presentation. So dangerous game to play in finance, but watch these metrics closely, for a gauge of the business cycle and a potential turn over the balance of the year. So, Fed Chairman Powell's days are numbered. Trump clearly wants lower rates. He's even mentions he wants rates as much as 300 basis points lower. And markets generally welcome lower rates with bullish sentiment. So the question is, how much is already priced into markets in terms of Trump likely getting his way. I mean, it's just been a flurry of headlines this week. Bloomberg reported that Trump is likely to fire Powell soon. That NBC News was reporting that it's highly unlikely he'll be fired. And then, CNBC, I think hits the nail on the head where, regardless of what happens, Trump's next Fed chair pick is going to come with a credibility problem. And that credibility problem, being that Trump obviously is only going to pick someone that is going to do what he wants, that being lower rates. Which leads us into a reminder of this analysis, which we showed last time. And if you'll recall, the Fed cut rates 50 basis points back in September 2024. And this was the first time they cut rates since March 2020. So, history, suggests that Trump, should be careful what he wishes for as investors, looking at this data, have more to fear from the rate cut cycle than the pause, the period in which the central bank stops tightening but is yet to ease. So what this data shows is that, while the S&P index is up about 5% in the 100 days between the last Fed tightening, chart here on the left, and the first rate cut on average, and the 200 days after the first rate cut, looking at the data over here, on average is down more than 23% in the 200 days, after the first cut. So, what's happened thus far? Well, it's been anything but scary. Remember, the Fed's last rate hike this cycle was July 27th, 2023. So from then until the first rate cut on September 18th, 2024, the S&P was up about 25%. The green dot in the upper right hand corner of this chart here. We're now a little over 200 days, going to the chart on the right, since the first rate cut. And we've had two more rate cuts since then, but none since December. So we're really not in a rate cutting cycle yet, per se, but in a little over 200 days day period since the first rate cut, the market has done just fine. And if you ignore the almost 20% correction from mid-February to early April this year, up about 12% over this time period. So maybe history just isn't a useful guide this cycle, or perhaps the reckoning will be a bit delayed, like the 2007, the 2009 cycle, or the 2001, the 2002 cycle. Time will tell, but I think a very interesting analysis to remind ourselves of. So, why is this the case? Well, it's usually because the Fed is cutting rates into economic weakness, not strength. And during economic weakness, earnings usually fall, and when earnings fall, the market tends to follow. So you can look at the data here in the past rate cutting cycles. You can see the weakness in earnings. But if you look at earnings right now, everything looks pretty good. So this is from earlier in the year, but forecasts continue to be strong. You can see that over the course of 25 and 26, market forecasters are expecting solidly positive double-digit growth in earnings. So don't see too much weakness in the economy to speak of, to some of Mark's earlier comments quite yet. So one may, wonder why there's so much pressure on the Fed to cut rates. So to, tie a bow on kind of the market outlook and also to some comments Mark, alluded to earlier, there's no investment so good that a high price can't make bad. And if you just look at valuations right now in the market with the S&P trading at, 22, 23 times earnings, the valuations look stretched. So even if the forecasters are right, kind of looking at the analysis here from Goldman Sachs, a lot of good news, a lot of earnings growth is already priced into the markets at these levels. So markets could certainly continue to trend higher, but the risk reward with every tick up, is increasingly looking less and less compelling. And you can see here, even if multiples just went back to the 5-year average, markets over a 12-month period, looking at 2026 earnings estimates would be flat to down. If we reverted to the 10-year average, down, quite substantially. So,
Well, a really important point there, Corey, that, I just find it interesting. I guess that's the best term I can come up with without being overly critical, how Wall Street and media have just moved the bar in the sense of, everyone now talks about this forward earnings like it's a real thing. And they're just not, right? The actual reported earnings, the earnings that have actually happened over the last 12 months, the PE of the S&P is 29.86. So, rounding easily to 30 times. And that's relative to, a long-term average, not the last few years of QE pollution, but over long term, closer to 15 times. And so when you look at the comparisons that people do all the time, they take this forward number, which is always high, right? You look at the beginning of the year, people always estimate that earnings can be X, and then they just keep ratcheting them down over the course of the year so they can beat the revised estimate. So I just think, again, I don't know what the catalyst is. Someone asked me the other day what the catalyst is that changes this. I don't have that part of the puzzle, but from a just math perspective and a logic perspective, there's just not enough growth globally, and particularly real growth, not, debt fueled growth, which is another topic for another day. But there's just not enough growth to justify these levels. So then you say, well, then why the levels keep going up? Well, it's a function of passive investing. There's now the majority of assets, particularly in the US, are in these passive structures, and they just don't have a choice. If the money gets put into the 401k account and it selects an S&P 500 index, they have to buy the S&P 500 index, and they have to put 8.3% of that money in NVIDIA, irregardless of whether NVIDIA trades at 27, 28, 29 times revenues, forget earnings. Again, just based on logic, you couldn't grow fast enough to justify that. And no, I should say, if you were to be able to grow at 70 or 80% compounded a year for a decade, yeah, you could grow into that. But no company in the world has ever done that. So it's a really interesting dynamic, how these valuations work, and the place we find ourselves which is if you choose to just not participate, you look in some ways like you're falling further and further behind. So you got to find other places to put your capital that'll still grow. But I don't know. It's a very interesting scenario.
Yeah, now there's a good insights, Mark, and I think that to sum it up, I think the odds of, consecutive 20% plus years here in stocks is not impossible, but improbable. And we put the, probability of that playing out, pretty low at this stage, given the starting point. But also to those insights, that doesn't mean there's nothing to do. There's actually a lot to do. And turning to the themes, the more exciting, in my opinion, part of the presentation, despite the overall market looking, more richly valued than undervalued, there are a lot of exciting pockets of opportunity. Healthcare being one of them. We've been beating the drum on biotech for a couple years ago, saying it reminds us of IGV, so the software index in late 2022, when we, are also pounding the table on that dislocation. And if you look at, IGV, it's just really funny how quickly, narratives can change. And, we've gone from, AI is going to kill software to, software is going to be one of AI's biggest, beneficiaries. And, software stocks have, traded up very handsomely from the lows coming out of the 2021, 2022 correction. We think biotech looks very, very similar in a lot of respects, and kind of looks like a coiled spring here. And biotech's just been a horrible place to park your money, really for 5 years now. And if you look at the valuations, in some of the stocks in the sector overall, one of our managers has quipped recently that we might never again see, such an opportunity at hand. So, looking at the year-to-date price action, it's been rocky. Healthcare stocks have gotten off to a rough start. In addition to the tariff worries initially hitting stocks, healthcare stocks have additionally been hit by fears that the new administration would impose significantly unfavorable policies towards the industry. A lot of these worries have started to abate. But importantly, despite all the negative rhetoric, biotech has not made new lows. And we've bounced off, this line here, looking at the XBI, around, $65, one, two, three, four, five times now. So, we think there's a lot of headroom for, the space to recover, to get back to the longer term channel that dates back many, many decades. So, if you look at, some of the valuation dislocation, in the sector, you really have to kind of ask yourself at this point, how low can you go? And if you look back to early April, at the lows, a record, nearly 30% of U.S. listed small and mid cap biotech companies, so nearly 200 companies, were trading at or below cash, so with a negative enterprise value. In other words, one could invest in the future of healthcare at, startup prices. Yet investors, looking at some recent data, are historically bearish, even with the, underperformance the last 5 years, and, the valuations where they are, and the underperformance in the sector versus the broader markets. Stifel, which is a bank that follows the space and participants closely, counts 93 healthcare-only specialist funds with a combined AUM of 251 billion. And of that 251 billion, I mean, this is almost too bearish to believe, but only 71 billion of that 251 billion being in long positions. So still just, very negative sentiment. But according to one of the managers we trust in the space, the overall fact pattern suggests a recovery, through normalization of sentiment. and rationalization of valuations, as the healthcare industry remains a vital part of the economy, delivering care and innovations to meet societal needs that are only rising due to an aging population. So there are some signs of life and few bright spots to note. And it's really not going to take much to turn around the trend in the sector. Um, if you look at, the chart on the left here, Merck a couple weeks ago announced a big, deal in the space, $10 billion, buying Verona Pharma to bolster its lineup within the chronic obstructive pulmonary disease area, as it's bracing for the 2028 loss of patent exclusivity for its blockbuster cancer drug, Keytruda. So this is a sign of, value in the sector being recognized. And, big pharma, as we all know, has enormous, pipeline holes that need to be filled over the next couple of years. And then, the chart on the right, always a bull market somewhere, even in a sector that's traded as terribly as biotech. I've talked about Insmed before, but they, really making breakthroughs in, treatment of pulmonary diseases, bronchiectasis specifically. And, despite all the headwinds, in the space, breakthroughs like this, are still being rewarded by the marketplace. And, the stock has done extremely well, despite the overall bear market in the space. So remain excited there. Another theme that we're following closely, getting even more excited about, is Chinese recovery plays. So shared these words of wisdom last time. Great returns often come from investing in out of favor situations. It's not much in the investing world more out of favor right now than China. Be fearful when others are greedy, and greedy when others are fearful. Obviously, there's a lot of fear right now as it relates to anything China related, and that made our antenna go up, a couple years ago in terms of potential opportunity, and also quip that Chinese stocks reminded us of the software sector in late 2022. And if you recall, at the end of 2023, we talked about this. A lot of China managers were saying that no major stock market had ever been down 5 years in a row. Kind of thought this would be the kiss of death, but sure enough, China was up in 2024 and up nearly as much as U.S. stocks. And even so, it's been a rough 7 years since 2017, but we think that's starting to change, and it's really time to pay attention. And if you look at price action thus far year to date, solely based on stock markets, China arguably is winning the trade war. Chinese stocks, you look at the Hang Seng, up a strong 22% versus the S&P up only 6%. And when China starts talking about supply side reforms, investors need to listen. And recently, Xi Jinping stated that China needs to lawfully regulate enterprises, disorderly low price competition, guide companies to improve product quality, and promote the orderly exit of outdated production capacity. And to the earlier comment about there's no investment so good that a high price can't make it bad. The reverse is also true, that there's no investment so bad that a low price can't make it good. And if you look at this company here, LONGi Green Energy, it's actually the largest solar company in the world and in China by market cap. China is the leader in technological advancements in the space, and in terms of unit economics and pricing. And this company is down 82% from the peak in 2021. And this is one of the sectors where the government is laser focused on addressing overcapacity. And we think LONGi and some other leading large cap companies are likely to benefit. And the government's done this before, successfully in other sectors such as met coal in 2015, 2016, aluminum more recently, and there have been some great investment opportunities as a result. We think Chinese solar is one area investors should be paying very close attention to at the moment. And then going to rifle shot shorts. Some other words of wisdom here. Short selling is tempting, but it's ruined a lot of people. Being short and seeing a promoter take the stock up is very irritating. It's not worth it to have that much irritation in your life. The short side, separates the truly great from the merely good. Don't short open-ended growth stories. Mess with the bull, and you will get the horns. And short sellers are certainly getting the horns right now. Shorting off the bottom in early April has been an occupational, hazard. But in talking to some of our managers, the risk reward looks very asymmetric right now in some of the most high flying kind of narrative driven corners of the market. Where the fundamentals really don't add up to where the businesses and stocks are being priced at the moment. We kind of before getting into the actual example, this just shows the market environment for short selling. This is an index, Goldman Sachs index that measures the performance of the 50 most shorted stocks, and you can see that if you're short these stocks, in February, March, early April, it felt like a hero. But since then, it's been a one-way train in the other direction. So it kind of reminds me of something Jim Chanos is famous saying about short selling, in that short sellers are generally miserable 11 out of 12 months every year, but that one month when things go in their favor, they're the happiest bunch on the planet.
It's like
Um,
most golfers, Corey. The average golfer, I think, what is it? Get this number right. I think it's 94% of golfers like never break 100 on the underside, and only 6% consistently shoot below 100. So the average duffer, gets one or two good shots in 18 holes, and it brings them back. The challenge, but golf, you play the round and it's over. With short selling, when this type of movement goes against you, and we saw this, I remember back in 2016, second quarter 2016, it gets to the point where, these are very smart people, right? They are intelligent people. They've done really good work on these companies. Fundamentally, they are right. And it becomes so difficult for them to kind of get out of the way, because when this goes against you, you look like the data's better. And I don't know that this type of, it's like a 60-degree angle ascent. Um, that is significant pain. There have been a lot of liquidations. Um, I don't know. It's hazard, what do they call it? Hazardous to your wealth, so to speak, not hazardous to your health. Um, but the alpha of short sellers, despite, outward appearance, is really, really high. It's just, as Corey said, concentrated in small amounts of time. But um, the challenge is how do you survive the middle game, to use the chess term, to get to the end game, where, to take Wirecard, for example. One of our managers famously was short Wirecard, and absolute fraud, payments company. But it got included. It went up so much in a short squeeze that it got included in the DAX index. So then everybody in Germany and everybody globally that owned the DAX had to buy it, and so it went from, like, I don't know, $30 to $300. I'm gonna get the numbers approximately right. Um, and our beloved manager had to eventually step to the side. Um, and it went, I don't know if it went to zero, but it went down 99, 98% when it came out that they truly were a fraud and a money laundering scheme. But um, it's tough business.
yeah, and I mean, looking at the example we'll bring up again, just an area where folks are kind of pointing their finger saying this doesn't make sense. but where narrative is really driving the story, much more so than fundamentals. Quantum computing and anything to do with quantum computing has pretty much gone parabolic since Google's update on its quantum computing efforts last year. If you look at some of the stocks here, they were trading at silly valuations. Now they're trading at even sillier valuations. If you look at D-Wave, for example, when we first talked about this in mid-February, it was trading at a $1.3 billion market cap, a $9 billion of revenues. It's now trading at a $5.6 billion market cap without a material change in revenue. And the same holds true for the other names on this list. The valuations have really just gotten even sillier without much justification on the fundamental side of the equation.
Well,
And
and it's to that point, Corey, it's worse in the sense that a number of these companies are consulting companies. They don't even have a product, right? Because we don't have enough quantum dots today to create a really well-functioning quantum computer to do anything that's commercially viable. And so these guys are selling consulting services to companies to explore when they get a number of quantum dots that they could uh, anyway, to make a long story short, there's another company, Rigetti. They have, I don't know, $20 million of revenue, something
yeah,
like that.
that's the red line on the chart here. 12,
Yeah.
12 million, 12 million of revenue.
12 million of revenue. So they have 12 million of revenue and a last I looked, it was a billion. Oh, no, no,
Five,
no. I'm so far behind.
5.3 billion.
5.4 billion. So that actually makes, you know, NVIDIA look cheap when you look at at that type of nonsense. And most of that revenue isn't necessarily recurring. At least NVIDIA's revenue is maybe not recurring like every quarter, but eventually people have to upgrade and go from the H100 to the B100 or B200 or whatever the next one is. Um, I don't know. It's
Yeah, so I mean, most of these look like, as one of our managers likes to say, science projects and pipe dreams. And even if the technology lives up to the hype decades down the road, it's likely going to be, um, commercialized, and the breakthrough is likely to come from the likes of a Google or an IBM or another very, very well-funded, company that has been exploring, this space, for decades versus one of these guys. And the dilution along the way is likely to be massive, just given, how much, cash these companies are currently incinerating on a quarter in, quarter out basis. But the short interest, as we noted, is very high. So execution, to these comments is going to be incredibly tricky. But when they break, and they will, these stocks, are going to fall hard. But that's yet to be the case. The pain trade is on. These stocks, since we talked about them in mid-Feb, have only gone higher. But you still think it's an area, to watch. And, in this market environment, you really got to take a rifle shot approach on the short side. But, opportunities abound for, the skilled managers out there who can execute them and, live to fight another day and make sure they're in a position to be aggressive, when the bottom starts to fall out. So, the last, kind of high conviction theme, area we're following very, very closely that we've talked about ad nauseum is artificial intelligence. And, I think we showed this slide in this forum back in mid 2023 after the launch of ChatGPT, and NVIDIA is up about 4x since then. Arguably trading at a much fairer valuation today than back then, when they're really the breakout company in terms of the AI super cycle. And I think, a lot of the, value creation is starting to shift from the infrastructure layer, to the application layer. And, this is a decade plus long super cycle, uh, tons of opportunities to take advantage of. But we and our managers are increasingly starting to look at not just the infrastructure layer, but the application layer, as these LLMs get, smarter and smarter. Saw this data, this information um, the other week. Thought it was very interesting. And it basically shows that, the gains from LLMs are exponential and that in a few years, AI will likely be able to handle complex tasks with ease. And if the pace continues until 2030, they will be able to complete in hours tasks that take a human a month of working hours. So 167 working hours based on this analysis. So LLM benchmarking shows capabilities doubling every seven months. So, can't say it loud enough, but I think the future of AI productivity improvements is here today, and investors really need to wake up to that. And you see it in the deal activity. I mean, just keeping track of the daily AI headlines is a full-time job. It was my full-time job the last couple of days that I prepared for this presentation. But just going through some of them here, your term sheet reported that nearly half of all VC investments in the second quarter were AI with deals totaling 40 billion. The big one during the quarter being Meta's 14.3 billion investment in Scale AI during June, which was a portfolio company for one of our managers. The New York Times reported, everybody knows at this point, NVIDIA, first public company ever to reach a $4 trillion valuation. So NVIDIA spent 3 decades building a business worth 1 trillion and took 2 years to turn itself into a $4 trillion company. Just amazing. Uh, Bloomberg, reported recently that Mistral LLM in Europe, one of the leading LLMs there, is in the process of raising up to $1 billion. And the company was last valued at 6.2 billion in a funding round in 2024. As talked about, Meta making a huge bet in Scale AI, not just for the technology, but also for the talent, bringing over Scale AI's founder, Alexander Wang into Meta's leadership to head its new superintelligence AI research lab. Elon Musk's XAI is in the process of raising more money at close to $200 billion valuation, which is a significant step up to that $80 billion valuation, where it was valued in March when the AI startup acquired X. TechCrunch, reported that OpenAI, closed one of the largest private funding rounds in history earlier this year. This was back in the first quarter, in the second quarter, raising 40 billion at a $300 billion post-money valuation. Zuckerberg is playing catch up now and, spending, Meta's huge cash pile to do so. Allegedly offering pay packages, well into the triple digit millions of dollars to lure some of the top AI talent from competitors like OpenAI and others. Grok, a company we've talked about before, is currently in discussions to raise a new round at a $6 billion post-money valuation, versus the $2.8 billion valuation in its last funding round mid last year. And the list just goes on and on and on. I think one of the most important slides in this deck, perhaps the most important, is this slide here. And we said we'd circle back to this earlier in the presentation when we were talking about CapEx. But if this spend wavers or falls off, watch out. But this is really fueling and propelling the U.S. economy right now. And you can see that, the Mag 7. So what this shows is the CapEx of the Mag 7, versus the S&P 500. And it's risen to, close to a third of total S&P 500 CapEx from less than 10% a decade ago, and on a absolute basis, now measured in the hundreds of billions of dollars, at 200 billion over the last 12 months. Meta, just this week, announced it's building several, gigawatt sized data centers, the size of Manhattan, to power its AI efforts, with the first one expected to come online next year. And a gigawatt factory, just to put it into perspective, the sheer scale, could provide electricity to power 750,000 U.S. homes. Most data centers today only um, house hundreds of megawatts of capacity, but several AI and major technology companies, like Meta, like OpenAI, Oracle, and others, are involved in plans to develop ones capable of handling several gigawatts. Meta, back in April, announced it could spend as much as $72 billion dollars with the focus on AI and data center investments. But in Zuckerberg's post earlier this week on Monday, he said the company is going to invest hundreds of billions of dollars into data center capacity to build superintelligence. So, this spend very well could be, the linchpin for the U.S. economy over the next couple of years. So it's a very important metric and measure of CapEx to follow closely as we all try to figure out what's going to happen with the overall economic and business cycle. So with that, that's kind of all I had for today. Not sure if there's any questions or comments, but would love any questions that you have, any feedback. Mark, not sure if you have any closing remarks, but thank you for everyone's attention.
So I guess the only thing I do have one, I'll throw out a question and see if anyone else has questions as they uh, come up here, or people are free to roam and get back to summertime. But as you've talked to the managers, as you do on a weekly basis, and try to kind of get to their best ideas, that process of our best ideas portfolio. Have there been any, I don't want to say themes, because you did the themes in the presentation, but have there been any common kind of, I don't know, intonations or um, discussion points? And what I'm trying to get at here is, in theory, this should be like a nirvana period for long short equity stock pickers, because you've got lots of haves and have-nots, lots of winners, lots of losers. And I'm just curious if they're seeing that, or whether it's just been frustrating, as rising tide lifts all boats.
Yeah, I mean, it's hard to generalize, and I'd say, in the main, we kind of look for managers that do different things. So we have a diversified portfolio of best ideas. Um, so if, a lot of people were saying the same thing, or singing from the same hymnal, if you were, Will, that would kind of raise an alarm bell with me that we didn't do a good job picking kind of independent thinkers and people doing different things. But, one thing that does jump to mind is that a lot of a lot of people, to use a sports analogy, want the ball right now. I've had a couple conversations with managers in the last few weeks saying, the thesis is starting to come together. Now's the time to get aggressive, and went through a couple of those themes today. One manager more generally saying the short side has been brutal, the long side's been doing great. But if I look at the asymmetry in my book, it's the best it's ever been in the last couple of years, particularly as it relates to the short side, as some of these companies are donuts, and meaning zeros, and they're trading at, nosebleed valuation. So increasingly hearing from folks that they want more capital, they want the ball,
Yeah.
and that despite the volatility, and despite, overall markets looking very valuation rich and heavy. And if you're a long only investor, there might be less to do as a result. that they're seeing, tons of opportunity if you lift up the hood and, look in some, more, I don't know if esoteric is the right word, but some
Yeah.
more less traveled parts of the market.
Yep. So one last one for me, and then see if anyone does have any questions, or we'll wrap. Um, you recently participated in I think it was the 18th anniversary or 15th anniversary. I can't remember which number of Light Street. Which number was it?
15, 15.
15th, 15th. So the 15th anniversary, and which is a long time, and we were there, literally on day one, backing uh, Glenn and the team. And Glenn, yeah, I've known Glenn for even longer because we backed him in his previous iterations, both in the private markets and the public markets. And Glenn Kacher, and he's spoken at our events in the past. I always said that he was a seer. And I don't mean like a psychic or anything, but I mean he was one of these people that he just had this uncanny ability to see things clearly that were coming down the pike in technology, before people talk about it. The great wealth comes from investing in innovation, which means investing in something that you believe in before most people understand it. And maybe give a couple of the highlights, as he kind of reflected back over 25 plus year career of tech investing, and how he hasn't lost 1 ounce of enthusiasm for the opportunity set in tech right now.
Yeah, I mean, he's definitely, someone you should follow within the space. When he speaks, we listen. Um, he's a great identifier of these super cycles and has done so, in tech repeatedly over the last 30 years. Everything from mobile to social to cloud. And he's really been one of the earliest, kind of, table pounders in terms of the opportunity in AI and it being a super cycle. And he thinks we're just getting started. He also thinks, the opportunity from an investment standpoint is starting to shift into the application layer. That's often the most, exciting and your biggest value creating, part of these super cycles. And he thinks that, we're in the early innings here and actually used a verb which I really liked on the webinar. We was talking about the 15th anniversary for his firm, refactor, saying that, he sees, literally trillions of dollars being, refactored, across the technology infrastructure stack to, prepare for an AI world. And yeah, the spend is large, looking at some of the earlier numbers like, Meta spending hundreds of billions of dollars. But, this opportunity is literally measured in the trillions of dollars and there's going to be winners and losers. There's going to be moments of euphoria and moments where valuations don't make much sense. But if you focus on the long run, you realize that this is a super cycle and you stay the course, massive wealth is going to be generated. And that's why we're so focused on it. That's why it's going to continue to be one of the themes we repeatedly talk about. And it really stems from conversations with smart folks like Glenn, who, are closer to the innovation, being in Silicon Valley, having invested in both the private and public side for decades than anyone else. So it's not just Glenn, but, it's a handful of folks like that Morgan Creek has had the opportunity to partner with and build relationships with that we really lean on to point us in the right direction in terms of these big overarching market themes. So
Yeah,
um,
and just on that point, and again, we'll let people go, is the the proximity factor is so critical. I don't want to, I mean, I'm prone to hyperbole, but this really isn't hyperbole in that, yes, the internet brings us closer together and we can access information all around the world. Um, but there is something about being in the heart of the valley, in the Palo Alto, Menlo Park, area. Just a quick little one. So when I see my son and daughter-in-law, they live in San Francisco, and we drove down to show our youngest, who is a long way before he goes to college, but he's super interested in robotics and super interested in engineering, and he's like, I want to go see Stanford. I'm like, great, tough to get in, but great, we'll take it. And we're just walking around, and the quad, right? You got one building is Hewlett, one building is Packard, another building Jensen Huang just put up, and Gates has got one across the street, even though he's not really a chip guy. Um, and then we snuck in actually. We tailgated on some students going into the robotics lab, and we're just walking around, and it was just stunning to see what was happening in this building in the middle of this amazing beautiful campus in real time. And Glenn and his team are there. They've got access to these people. They're part of the alumni network. I just it's just amazing. And unless you're immersed in something, it's really easy to dismiss it and really easy to say, oh, it can't get any bigger. It can't get any bigger. I've already made a lot of money. I'm just going to sell and take my profits. And you look at something like the turnaround at AMD, which might be one of the most important companies in the future because of some things they're doing. And they were left for dead 10 years ago, and the stock went from 3 to like 150. And in NVIDIA, I remember internally we have a guy that worked on the team who was an early investor in NVIDIA because he was a gamer, and he was using their video cards, and he's like, these are just better. And long story short, I remember talking around the table, the stock had gone up, I don't know, 20 times or 25 times. And everybody's saying, oh, we should be taking profits. And he's like, you guys are crazy. And this is when it was a probably $400 or $500 billion company, and now it's a $4 trillion company. So that ability not to be jaded by the pure math of the valuation, which is my biggest struggle as a value guy, and just to be able to have that belief in the innovation and to ride your winners. That's the one thing they said was great about Julian Robertson, right? Even as a dyed-in-the-wool value guy, he had an uncanny ability to double up, and it serves investors well. And yeah, a pat Corey on the back, even if you weren't here. The relationships he's built with these investors over the decades is irreplaceable. It's irreplaceable. It's profoundly important. It's profoundly valuable, and it's really a gift, for me to participate as an investor and partner in the fund, because he's the one doing the work, building those relationships and maintaining them, and getting the advantage for all of us investors. So,
Well, thank you, Mark. My cheeks are red, but I appreciate the compliment, and yeah, we also appreciate all of you guys, everybody who listens to our webinars, everybody who invests alongside of us. That's the rewarding part of our jobs, and even if we have the best ideas in the world, if we don't have clients and investors, none of it matters. So thank you all for your attention today and the questions and just the dialogue and back and forth. And we look forward to being in touch with you soon.
all right. Happy summer. Talk to you guys soon.